We have got rising home prices but no housing crash in sight. Let's take a look at what are the factors that are causing the rising home prices in addition to low inventory and the interest rates. My name is Rupa Nampally, Realtor with Remax One. Hope you will stay tuned to the full episode. The most recent job report looks good for the housing at the end of forbearance. In February 2020, we had 1.5 million non-farm payroll workers, but today, as of May 2021, we have 1.3 million non-farm payroll workers. In the previous expansion, which was the longest economic and job expansion in history, the all-time high for job openings was 7.5 million. Today, we have roughly 7.3 million job openings, and the number should get to 10 million by the end of this new expansion. As you can see with the chart, not only has the housing data performed much better during this crisis, but job openings are roughly 5.5 million higher today than the worst levels of the great financial crisis. Rick Sharga, Realty Track Executive Vice President, said in a statement, "With the federal government's foreclosure and eviction moratorium, coupled with CARES Act mortgage forbearance program, the government and the mortgage servicing industry have worked together exponentially to prevent many of unnecessary foreclosures. Because of these programs and the nearly 90% success rate of the borrowers resuming mortgage payments as they exit forbearance, a large influx of foreclosures when the program expires seems very, very unlikely." The Consumer Financial Protection Bureau released a notice of proposed rulemaking in early April that would amend Regulation X to provide a special pre-foreclosure review period prohibiting services from starting foreclosure until after December 31st, 2021. Under current Consumer Financial Protection Bureau foreclosure rules, a borrower must be 120 days delinquent before the foreclosure process can start. The Bureau said that nearly 2.1 million households in forbearance are past the 90-day delinquent mark and said it is concerned that those homeowners may be transferred immediately into the foreclosure process once their forbearance period expires. According to the Bureau, while many protections of the CARES Act only apply to federally backed mortgages, the Bureau is looking to set a blanket standard across the industry so that all homeowners who have similar protections, regardless of who the owner or servicer of the loan is. According to Freddie Mac's weekly preliminary mortgage market survey, which showed 30-year fixed-rate mortgages averaging 2.96% for the week ending May 6th. The survey tracks conventional conforming purchase loans for borrowers who put 20% down and have excellent credit. Freddie Mac chief economist Sam Cather said in a statement, "Consumer income and spending are picking up, which is leading to an acceleration in economic growth. The combination of low and stable rates coupled with an improving economy is good for home buyers. It's also good for homeowners who may have missed prior opportunities to refinance and increase their monthly cash flow." The Mortgage Bankers Association reported that borrowers finally got wise to the continued drop in the rates and pushed mortgage applications up 2.1% after weeks of decline. So much so that decline in rates helped refinance index reach its highest level in 8 weeks, driven by a 4% increase in conventional refinance. According to the latest survey report from them, mortgage applications for the new home dropped 9% in April from March. However, overall applications are still up, whopping 30.8% year over year for home builders. Beginning in 1959, the U.S. Census Bureau started to record housing starts. During the 48 years between 1959 and 2006, builders completed almost 53 million homes for an average of 1.1 million homes per year. For the 14 years between 2007 to 2020, builders started almost 10 million homes or 700,000 homes per year, which is almost 400,000 fewer starts per year than the historical average. This annual shortfall totals almost 5.5 million homes during those years. In 2020, builders started 990,500 homes, still below historical average of 1.1 million annual starts. Homebuyers are now paying the price for the need for homes continued, intensified by combination of new developments that increased housing demand. Included are the COVID-19 lockdowns that forced many to work, teach and learn remotely, a population that continued to live longer, preventing their homes from being recycled. The question to ask is what has caused the demand and supply imbalance? For those who do not know or remember, in the early 2000s, the federal government wanted as many people as possible to own a home. To make that happen, lenders were encouraged, if not coerced, to abandon established lending practices, making risky subprime loans. Home loans originated without regard to credit, employment, or down payment. Circumvention of established lending guidelines was facilitated by unprecedented policies of FHA, FNMA, and FMAC that allowed sellers to gift down payments and closing costs to buyers through third parties. These policies allowed unqualified buyers to buy homes they could not afford and resulted in rampant mortgage fraud. What followed was an avalanche of foreclosures that triggered the severe decline in housing values, causing a 75% decline in housing starts. The longer and the most severe decline since 1959, when the US Census Bureau began recording that data. When the foreclosures made the loan worthless, FHA, FNMA, and the FRMC had to absorb the losses. The losses were so enormous that they put the entire US financial system on the verge of collapse. The solution was simple but expensive. A government bailout rescued the nation from the disaster that the government created, as it has done several times before. Unfortunately, the US housing supply will remain underserved for several years. A closely watched weekly mortgage rate survey from Freddie Mac shows rates continue to slide, but the snapshot of the average rates over a 7-day period doesn't fully reflect new data that pushed rates up on renewed worries about inflation. The optimal blue mortgage market indices showed rates on conforming 30-year fixed-rate mortgages climbing on May 12th and 13th, hitting 3.194%. Realtor.com chief economist Daniel Hill noted that core inflation, which excludes more volatile food and energy prices, saw the biggest one-month jump in 39 years. The last time inflation jumped that much in 1 month, Freddie Mac's 30-year mortgage rate was 16.9%. While I don't expect double-digit mortgage rates anytime soon, I do expect mortgage rates to follow Treasury yields higher as the combination of abundant supply and concerns about inflation mean the investors expect higher returns. Freddie Mac chief economist Sam Cather acknowledged while low mortgage rates have been a boon to the housing market, they may not last much longer as consumer inflation has accelerated at its fastest pace in more than 12 years and may lead to higher mortgage rates in the summer. On the other hand, a disappointing job report last week does give the Federal Reserve leeway to continue buying government-backed bonds and mortgage-backed securities to keep a tight lid on interest rates. Days on market dropped nearly 50% amid inventory crisis. The report reveals that monthly new listing volume is up 19.1% from April 2020. But the rate of new inventory still can't keep up with the crazy demand from home buyers. Jeremy Slicklick, co-founder and CEO of House Canary, said in a statement, "Last spring, the real estate market was rocked as a result of COVID-19 lockdowns. But what ensued was housing boom marked by residential home prices hitting all-time highs. Record low mortgage rates and extremely limited inventory coupled with unwavering demand from buyers." According to an analysis by Black Knight, the recent dip in mortgage rates has given additional 3.4 million homeowners the incentive to refinance. Last week, the Federal Reserve said it will keep trying to keep long-term interest rates low by continuing to buy at least $80 billion in Treasury securities and $40 billion in mortgage-backed securities every month until substantial further progress has been made towards hitting the Fed's employment and inflation growth. Housing inventory being at its all-time low, signs of increasing new inventory hitting the market and still not satisfying the buyers' needs, low interest rates, inflation worries, new home construction which is at deficit of 5.5 million homes since 2007 to 2020. All these factors are contributing to low inventory. If you are interested in selling your home and want to help the US economy maximize your home equity and help me keep me busy at the same time, now is the time to sell your home. Please give me a call at 732-397-9185 so that we can sell your home to the best buyer and to the highest value possible. Have a great week ahead.